Hello and welcome to the lecture for part one of what will be our last chapter for this class, chapter 18. So this deals with integrated audits of public companies. So we'll be looking in quite a bit of detail about what the Public Accounting Oversight Board requires for auditors as it relates to internal control specifically. So we'll start out by talking about the nature of an integrated audit. We'll talk about what management's responsibility is for doing this report. We'll talk a little bit about the auditor's responsibility. And then in the next part of the lecture, I'll talk about what approach the auditor takes to analyzing internal control and reporting on it. I'll talk about the relationship between the audit of internal control and the audit of financial statements. And then lastly, we'll talk about what kind of modifications might be necessary to be reported on the auditor's report of internal control. So to start off with, the nature of an integrated audit. So audits of large public companies require a report on financial statements, of course, which we just covered in the last chapter, and then also a report about the internal control over financial reporting. So this is something that was required by the Sarbanes-Oxley Act of 2002. So this is based on the Public Company Accounting Oversight Board Standard Number 5 that deals with audits of internal control and financial reporting and requires them to be integrated. So the Section 404 is the key one here in the Sarbanes-Oxley Act. So Section 404A requires the annual report filed with the SEC, that's the 10K, to include a report on internal control that's provided by management. So the management of the company, and we'll talk about that in the next couple of slides, the management of the company is required to issue a report on internal control. So in that report, they'll acknowledge their responsibility for establishing and maintaining adequate internal controls, and then they'll report on their assessment of internal controls over that same period, or as of the end of the fiscal year, rather. So Section 404B, now for companies that are 75 million, have a market cap of 75 million or more, meaning the price of their stock times the number of shares outstanding. If it's over 75 million, then it requires a CPA firm that does their audit to also audit internal control and express an opinion on the effectiveness. So it's just for the very larger companies that auditors are required to do that. So management is responsible, one, for accepting responsibility for the effectiveness of internal controls. That again is their responsibility, not the responsibility of any outside group. They're responsible for evaluating the effectiveness using suitable criteria, primarily the avoiding material misstatements on the financial statements and avoiding fraud. They're able to support their evaluation of their methods of internal control with sufficient evidence of what they're doing, and then provide a report, which I mentioned is included in the 10K that they file, which is the annual report filed with the SEC. So management's evaluation of internal control really follows a very similar pattern to how auditors evaluate internal control when they're trying to make their determination about the extent they can rely on the company's internal controls in determining how much substantive testing that they need to do. So the first thing they'll do is evaluate the design effectiveness. So assuming that the controls were operated perfectly, would they meet the requirements the company needs? Meaning, would they avoid any material misstatements in the financial statements, and would they prevent fraud? So that's the design effectiveness. So are they set up correctly? And again, something could be set up correctly and then the way business is done changes, so it's no longer adequate. So it was designed effectively, we can now forget about it. It's a reassessment every year. I would mention that that the first year this is undertaken, it's quite a bit of work. And then in following years, it's a matter of updating what has changed and checking to make sure things are still working properly. So the first step is evaluating the design effectiveness of controls. Again, this is something management does. The next step, like an auditor would do, is to see, okay, they've got well-designed controls. Now, are they operating effectively? Are they following the rules that are laid out? They'll have to document that process, so detail all of the different steps and how things work in each of the different transaction cycles within the company, and then they'll issue their report. So management's report on internal control, it has to include some things. It has to state that it's their responsibility to establish and maintain adequate internal control. That's clear. It has to identify the framework that's used for evaluating internal controls. I'll talk about that in the next slide. And then it has to include management's assessment of the effectiveness of those controls as of the end of the most recent fiscal period. That's important. It's not stating that those controls, those effective controls, existed throughout the entire year, but as of the end of the year, did the controls exist and were they operating properly? So again, I mentioned when this is done the first time, it can be quite a big job. So it's okay for a company to use outside consultants to help them with that. The one thing they cannot do is they can't use the CPA firm that's going to then audit the financial statements. And that would be a natural choice for a lot of companies because they have a relationship with the CPA firm that's done their audits. The CPA firm is very familiar with their company, familiar with their internal controls. So it would be a natural selection to say, would you please help us with this? But then that puts the CPA firm in the position of then auditing their own work, which is inappropriate. So it has to be a consultant outside of the auditor's office. They have to indicate that they understand internal control as the SEC defines it, and they have to use an accepted framework. The most common being the integrated framework created by the Committee of Committee of Sponsoring Organizations. I apologize. I always get tripped up on that. So they have to understand the concept of control deficiency, significant deficiency, and material weakness, and delineate between those. So control deficiency exists when either a control is designed improperly or is not operated effectively. And it allows management or employees to not prevent a mistake from happening or fraud from happening, or to not detect it, allowing them to correct it after it's happened. So remember, we talked back in internal controls about preventive controls and detection controls. So we'd want to look at both types here. So a deficiency would be either, again, it was designed improperly or it was operated improperly. And there's levels of severity. So less than significant deficiency, that would be something that didn't create a material weakness. Maybe they don't have proper procedures for petty cash at one of their subsidiaries. The amounts are small. It doesn't have a material impact on the overall financial statements, but it's still a deficiency. If it's a significant deficiency, it's a little less severe than a material weakness, but important enough to merit attention. So it kind of is in that in-between range. And then a material weakness, there's a reasonable possibility that there would be a material misstatement if given the fact that this control is not operating properly or was not designed properly. I'm going to talk about the consequences of those three levels of deviations or deficiencies in the part 2 lecture. So we'll come back to that. So now let's talk about the auditor's objective. So they need to plan and perform the audit to get reasonable assurance about whether material weaknesses exist in order to express an opinion about the company's internal control, but also about their financial accounting. So the thing that's important to take away from this is issuing an opinion about internal control is not a separate engagement from issuing an opinion on financial statements. They're kind of interlinked, and work that is done to assess internal controls for the purpose of the financial statement audit, meaning to assess risk and determine what level of substantive tests need to occur. That's going to take place throughout the audit. We're going to collect evidence through questionnaires and through flow charts and interviews with people about internal controls throughout the audit. And that'll form the basis for our opinion about internal control at the end. The key thing here is the date. So when we look at internal controls relative to auditing financial statements, we care about the internal controls that existed throughout the year, because the financial statements at year end, of course, cover the transactions that occurred over the course of the year. So I'm as worried about internal controls back in March as I am in December, okay? When it comes to the influence of internal controls on how we audit the financial statements. When it comes to our opinion about internal control for the audit of internal control, for expressing an opinion about internal control, we only care about the internal controls as they exist at the end of the year. So a company, say in an extreme example, maybe they don't have anybody doing bank reconciliations during the course of the year, so that's a lack of control. But late in the year, they figure that out and they train somebody and get them doing reconciliations. So at year end, bank reconciliations are being done. So in that case, the fact that they weren't done during the majority of the year would have a big impact on how we audit the financial statements. But when we express our opinion about their internal control, we're expressing our opinion of how it exists at year end. And so in that case, we would say it was adequate, at least in that respect. So the other thing is a different motive in looking at this. So the motive of looking at internal controls during a financial statement audit, like I mentioned, is to say, well, how deep do we need to dig to feel comfortable about what this company's reporting given the level of internal controls? That's our motive. When it's about expressing an opinion about the company's internal controls, that's a little bit different motive. It's just to express that opinion. Talk about taking a top-down approach. Really what that means is how to prioritize looking at internal controls for the sake of issuing an opinion about them. So looking at the top, meaning the overall financial statements, entity level controls. So what's the environment in the company? What are their rules about ethics and all of that? That we would look at how the audit committee functions. Is there a strong audit committee that is exercising proper oversight? That would be important. What are their views and policies about fraud? And then how do they go about creating financial statements? Kind of what is the process in creating financial statements? I worked for a company once that the CEO required that I give him a copy of the financial statements before I submitted them to the parent company every month. He would review them and then he would suggest adjustments that I was to make before they were finalized and sent on to the parent company. That would be something that an auditor looking at internal control would be very interested in, because it suggests an opportunity for management to manipulate results, which was the case in that situation. So I will end part one here, and we will pick up on the next slide where we talk a little bit more about that top-down approach, and I'll give you some examples of deficiencies that you should be aware of in the next slide, starting with part two. Thank you very much.